Hey everybody, Carvana has taken investors on a wild ride over the last 16 hours or so. The stock dropped 10% after hours yesterday. It shot up 50%, 60% before the market opened today, and then right at the open traded 20% higher. I'm going to teach you, number one, a very basic rule that I should have followed yesterday, you should have followed yesterday, everybody should have followed, but we rarely see it. It's one of those rules on Wall Street that should tip the hat of an announcement like this. Second, we're going to go through what happened with Carvana stock, why it's up 20% and likely to go even higher. And then third, how I would trade this personally as we move forward. So let's take a look at the stock. Real quickly, here you go. This is the pre-market activity of Carvana. You can see we traded as high as $60, and that is coming off a 10% loss right after the close. What happened after 4 o'clock yesterday? Well, the company came out and announced that they were moving their earnings date up. So in other words, instead of August 2nd, they were going to come out with their earnings results today, July 19th, before the market opened. The market reacted with a knee-jerk reaction of selling the stock and taking it down 10%. Ignoring one of the basic and most simple rules of Wall Street. Let's get into that for just a second. When a company moves their earnings date forward, they're typically trying to get good news into the market. They're trying to take advantage of a market that is in rally mode in this particular case. They're trying to set the stage for a stock moving higher on positive news. Everyone, including myself, kind of put that rule aside and said, oh boy, what is Carvana going to drop on us now? And think about it. Just yesterday, I told you about the Manheim Used Car Index and how prices are going down fastest since we've seen the pandemic. And then you look at what Carvana has been wrestling with, overhead looming debt that has payments coming due, those bonds that they were worrying about, which has just been crushing their balance sheet. So everybody thought the worst case scenario instead of the best case scenario was out there. Let me give you the other side of that rule real quickly. When a company moves their earnings date forward, it means that there's likely to be some good news. When a company moves their earnings date back, run for the hills, folks. That means that they're trying to brace the market for some sort of bad news. They're delaying the inevitable, and usually they're taking that time to put their messaging together, go through the numbers a second time, make certain that they get their institutional investors in line. All of those things they need to buy a little more time to do. So that's what happens when you see a company move their earnings date back. In this case, we saw them move forward, and it was good news. Carvana announced this morning that they are indeed getting rid of a chunk of that debt, more than $1.2 billion. And they're pushing this off on an agreement with the note holders here. So those debt holders have come to the table, seen what's going on with Carvana in terms of the sales, etc., and said, you know what? We're going to take them off of this, let's say, this credit watch or this situation that feels so dire and allow them to start putting some equity out there and replace those notes. And that's exactly what has caused some of the volatility in the stock. Let's take a look at this. The shares did trade as much as 60% higher, and then you'll notice that they dipped right back down lower. Why would they on such good news? Well, the company also announced that they're going to put an offering out there of their equity shares. So in other words, they're taking care of the debt right now that is going to sit on that balance sheet by replacing it with equity. So you and I get to take a little bit more of that risk. And remember, the bondholders are always lined up first to get that money out of the company in the worst case scenario. Now we're going to be lining up more equity holders as the company is going to go out there and sell, from some reports, up to $1 billion in equity to help fund this shift or this refinancing of the balance sheet. From a couple different perspectives, this is good. It gets that monthly payment, if you will, off of the shoulders, or at least some of it for Carvana. They're negotiating this debt out to 2027 right now. So those unsecured notes are going to be a little less of an urgent matter right now at some point. Remember, they will come due, but at the same time, if interest rates are going lower at that time, they can refinance it just like you and I would, a high mortgage rate, etc. They'll be able to go to the market and hopefully get a little more, let's say, favorable interest rates on that debt. And it's all going to be based on their operations at that time. Now, the stock, as I look at it, the big question here is 25%. And as it trades up 30% today, heading back towards those highs of $60, is it a buy? Now, keep in mind, this stock was deeply depressed when it turned down to that $4 level and looked like it was going to trade down to zero. One of the zombie stocks that Shaw has been talking about for some time. And remember, part of the reason that it was one of those zombie stocks was because of all of that debt. It's not gone completely, but that restructuring again helps them to free up some cash. It actually has been reported that it's possibly up to $2,000 per car that this is going to adjust the balance sheet in a positive manner. That is a huge number. Also, on a side note, keep in mind, even though the debt was the big issue or the big news today, the company did come out and announce their earnings as well. That is the whole thing that they moved forward. They actually surprised to the upside by 52 cents. Their loss wasn't as bad as the consensus on Wall Street, which was for them to lose $2.03 per share. Revenue was down 25% year over year, and this is the second quarter in a row, but it looks like it's kind of trying to balance out a little bit right now. Watch those used car values in their inventory right now. But let's answer the question, would I be buying this stock right now, and what technicals would I be looking at in terms of making that decisions? And to do that, I've got to go and look at this daily chart, get rid of that little lasso that it looks like right now, and tell you that you're seeing a couple of different things right now from my perspective. Technical analysis tells me that whenever the crowd is running into a stock, everybody all at once, it's spending a lot of buying power at once. It's sucking all of that capital into the market. And this is the situation right now. Think of it as standing on the gas as long as you can in your car until it runs out of gas. And maybe you're on that last little drop. In this particular case, technically, that's what Carvana looks like. You've got a push that is well above that Bollinger Band, that top Bollinger Band. That tells you that this price increase is very unusual. Almost a black swan type of run. And for a stock to be up 32% as I'm speaking, you don't see that every day. So that's strike number one. Strike number two is that RSI index. That tells you whether it's overbought or oversold. It is way overbought right now, telling you that there's going to be some profit taking. Remember, you have people that were buying this stock down at $8, down at $4 earlier this year. At some point, they're going to want to take some of those profits off, and the RSI tells you that that is going to be coming soon. The next stage is the volume. I'm not really seeing a huge spike in volume today. I think you're seeing the market kind of digest some of this news, but with 2 out of 3, Meatloaf will tell us that technically this stock is set up for a little bit of a regression to the mean, likely down to that $40 price target, $13 from where it is right now. Let me show you one more chart, and this is the most interesting. People always ask, why is a stock stopping at this point when you're looking at the daily chart? Sometimes you just need to look at the monthly. Here's your monthly of Carvana, and you've heard me talk about the 20-month moving average, or at least you should have heard me talk about it before. In this particular case, it's that orange line. 20-month moving average is that line of demarcation between a technical bull and bear market. I know there's a simple rule out there saying that 20% off of its highs. That's a little too simple, and it turns out that many times the case is stocks will reverse. In this particular case, you want to see the stock take out its 20-month moving average. Notice how it tested it back here in 2020 and then took off and fall, and then when it crashed through that 20-month moving average right there in 2021, at the end of 2021, end of a bull market cycle. So right now, Carvana, make sure you check it out at that 20-month moving average. It is right around this $54 price level. I expect to see a little bit of resistance at that price, and once we break above it, maybe give it a couple of weeks or so, you're going to see a stock that is going to enter a technical bull market again, and likely to get a little more credence from a lot of the institutions that have been holding back on buying Carvana because of this overwhelming debt. There you have it, a crazy, crazy wild ride that's likely to pin the stock somewhere around its 20-month moving average. Watch for a short pullback, and that may be your opportunity to step into this red-hot stock that just made a fundamental change for the better over the long haul. That's it for now. Chris Johnson, Money Morning. Make sure you like and subscribe to get more information like this. I wish you the best trading success, everybody. Bye-bye.